Sandeep Agarwal joining us for this discussion and more. Fund manager and co-founder Sovilo Investment Manager. It's also your time of the season, Sandeep, with regard to IT, and we will quiz you on that as well. But first off, on a trend and on the FMCG basket as a whole, first, your quick view with regard to a trend, how you view it, how you view the numbers, because this 15% stock decline, could it be a presentable opportunity for prospective investors?
Hi, good afternoon, and thanks for having me on the show. We run a PMS, so it is very difficult to comment on stock, and I won't comment, but let me give you some perspective that, FMCG obviously has been perceived as defensive for a long time, and rightfully so, because we have good GDP growth and growing population and, growing per capita income and all that, which augurs well for FMCG. But at the same time, the valuations have always been very demanding, and that's the reason they go a long phase of time correction and sometimes price correction. And right now we are witnessing it in some of the pockets, while because of Trump tariff, they are looking better now. But I believe that when sanity returns, and again, probably people will find other spaces where there is growth and will try to get out of them. So we want to buy FMCG and QSR space, but at right price, not at insane valuation. And I think some of the stocks are very insanely priced in retail, in apparels, in QSR, and even in FMCG. And those are the stocks which are currently not doing well, or where the one-day shock in price falls are alarming.
And what about the larger FMCG basket, Sandeep, if I may venture? QSR has been one space where there's been plenty of pain. Footwear is the other space where there's been plenty of pain. Do these pockets likely start to become more of something that would interest you at some point?
See, right now what is happening is that, the challenge is that most of the companies have some exposure to export, and those are getting hammered very badly. And compared to that, all these spaces are more defensive and looked at more like, domestic stories. So they are relatively better off, and that's the reason these arguments are coming off, that they have corrected quite a bit. There has been time correction, and whether we would like to look at them. Our view is that, what has happened relatively is that the stocks which we are in, which we like, the growth stories and all, they have become much more cheaper than earlier. So, again, for us, relatively, those same names make more sense because we have done a lot of work on them. We have been tracking them. So we will be preferably, there only. These spaces will become very interesting when, the multiples come down meaningfully. Right now, while there is some correction and more time correction, but still the stocks are very, very expensive. So very hard to, still make a bull case scenario or an investment case for them. But yes, for people who are taking 10-year, 20-year call, and where, there is a patient money and low cost of equity, there, this may make the cut, but probably for us, it is a little difficult.
Okay, also that time where we have an exclusive coming your way. Sources tell your channel that the government believes that India is better positioned amid the reciprocal tariff policy versus peers. Shrimi joins us with that perspective. Shrimi, what are you hearing?
Yeah, so top bureaucrat says NDTV Profit that, India is quite better positioned in terms of global trade landscape, as the country is...
Shrimi, we'll have to patch you. Shrimi, we'll have to patch you again. The line is completely not clear out there, so we'll try and get that going in just a bit. What are individual stocks, though, factoring in is the key question. Now, are stocks, are there companies or stocks which are recovering a little bit? So, well, a small cap stock, Umang Dairy, might be recovering a little bit, but not too much otherwise. Still, a clutch of names under a lot of pressure in the session today. Themis Medicare, Gravita. There's just a lot of pain out there at the mid cap and the small cap end of the market. Hemen, did we talk to you about FMCG? And I wonder if, while you only want to recommend a long if there is a gun put to your head, I'm enticing you with a coffee and asking you that would you buy an FMCG name for a trade, because they are bucking the trend today.
I think so, Neeraj, because FMCG has, FMCG peaked with the market on the weekend of 27th September. Having said that, HUL is the big gun. It normally leads the FMCG pack up or down. I wouldn't venture out to say this is a double bottom, but it's tested the previous bottom, and that previous bottom has held. So in a market like this, yes, I'd stick my neck out and say if you want to play for a small bounce, I think HUL seems like it. I'm not sure if the risk reward ratio is in favor if I tell you to buy with a stop loss of today's low. About 2300, I think it should surprise, and it's also making a medium term base. So yeah, FMCG, especially HUL, seems like it's sort of stabilizing after a multi-month fall, Neeraj.
Okay, fair call. Now on to that story with Shrimi. I believe we got Shrimi on a better line with regards to what the government believes about India's position. Shrimi, can you hear me?
Yeah, I can. I'm
Great.
sorry for the disturbance.
No, I can't help it. Please tell us. Yeah.
Yeah, so, the top policy makers tells NDTV Profit that, the India is currently focusing on enhancing its economic resilience despite this ongoing reciprocal tariff policies. And they are also saying, and in fact underlining, that this policy per se is implemented globally and are not kind of aimed at any specific country, and it's a part of a broader trade dynamic. However, the official admitting that there is a downside risk to the growth outlook amid this uncertainties, but the outlook for FY26 remains largely unchanged, which is in the range of 6.3 to 6.8% is what Economic Survey, highlighted. And as far as steep reciprocal tariff of 27% goes, India continues to engage in talks with the US. The government is actively working to finalize the BTA. And in fact, it's saying that it's, reviewing its existing tariff structure under this ongoing trade pact discussion. However, the policy makers are emphasizing that unlike some other nations, they have resorted to, go retaliatory measures. India is opting for more calculated approach, more balanced approach, and kind of aiming for stability and a long-term growth and trying to strengthen its economic ties with the US. So they're also pointing out that some of the developments are favorable for Indian economy, particularly the reduced energy costs, which are expected to benefit the country, manufacturing sector, and overall economic competitiveness. And they're also pointing it out that all those reforms which was announced in the February budget, as you remember, as far as personal income tax policies are concerned, they are going to have a positive impact on the economy, as the target which is being set for growth is mainly reliant on the domestic demand. So that's what the officials telling us at this point, that there is a downside risk. That more or less they are as far as economic growth is concerned, they are quite stable and steady. And they are trying to sort of finalize this trade deal to navigate this entire tariff issue.
Okay, thanks a lot for that. And from one policy, Shrimi, thanks a lot for putting that into perspective. The government, as you see, has hiked the excise duty by 2 rupees each on petrol and diesel. Somit joins in with more. Somit, why would this be the case? Are we also looking at a price cut at the till level coming in to offset this, if you will?
Well, yes, most likely this excise duty hike that the government has done, OMCs will take the brunt of that, and technically this 2 rupees hike will eat up to the marketing margins of the oil marketing companies, that is Indian Oil Corporation, BPCL and HPCL. Now, if you look at the integrated gross marketing margin that the oil marketing companies have been earning by selling every liter of petrol and diesel, it has been around 11 to 13 rupees per liter, which is at a multi-quarter high, and this has increased because of the sharp drop that we have seen in the crude oil prices. Now, this 2 rupees cut is what pretty much the street was expecting to happen, because last time also back in March 2024, government had reduced the fuel prices by around 2 rupees. So something like this was expected by the street when it comes to the oil marketing companies, and this time government has in fact increased the excise duty and not cut the fuel prices. So this 2 rupees hit that we are seeing will put down the gross marketing margins of the oil marketing companies. And if you look at the impact that could come in on the estimated EBITDA of these companies, it could be more than 10% for all the oil marketing companies, that is Indian Oil Corporation, BPCL and HPCL. Now, interesting part here to note is that will this increase in excise duty will also impact an inventory loss for the oil marketing companies. That is, we still need to watch out for whether that will happen or not. But at the face of it, it seems like this 2 rupees increase in excise duty will not be passed on to consumers. Oil marketing companies will take the hit of this increase of excise duty, and their EBITDA estimates could come down by at least 10 odd %. But do remember that oil marketing companies were already earning a very high gross marketing margin, and Street was expecting this to happen anytime soon. So not much of a big negative impact, given the fact that Street had already factored in. Had the hike been much more than that, then it could have been much more negative for the oil marketing companies here.
You can see those moves. Thank you so much, Somit, for that perspective. You can see those moves on some of those counters. Sandeep, let me first take your view with regard to OMCs and the excise duty hike. What's the sense like at this point with regard to that play?
No, so obviously, this is something which was not anticipated, and in my view, I think HPCL and BPCL were stocks which were least hurt today when markets opened until some time back before this announcement came in, and now with this announcement, obviously, the stock price has reacted. I believe in a way, when the way crude prices are falling, this company should be big beneficiaries of it. But probably, that information will come in, that processing of data will happen, and probably then that reaction will be separate. Right now, what we are seeing is a reaction to the excise hike.
Okay. Yeah, I mean, this is the thing that crude prices being lower, if anything, people are expecting a cut at the till. What we have right now is that may not be happening, but the government earning a little bit of that share and eating into the marketing margin of the OMCs. Now, it's a 3.5% gash for HPCL by virtue of that 2 rupee hike in these prices. I wonder if the trading picture for these stocks gets damaged. I mean, not that you were looking to trade into any of the companies, but I thought the oil marketing company charts were looking much more resilient because of the crude price fall. Does this damage this, or is it just a small blip for them?
Oh, well, Neeraj, frankly speaking, what you said, I totally agree with you. They were looking much more resilient than the rest of the market. So as of now, it seems like a blip, but this blip turns into a deluge if we don't stop at around these levels. So things were stabilizing, things were looking good, they were correcting, support, everything. Like you said, resilient, and I feel, in fact, HPBP, IOC, all of them looked as if they were still in a correction within a bull market. So as of now, it is a small blip. Now, if HPCL closes, okay, it's far off, but if it closes below 320 on the weekly chart, I think then it creates a problem.
Okay, so those are some views coming on OMCs. Also wonder what what you make of metal counters, Sandeep, because that's one pocket where there's been significant pain both on Friday as well as today. The Nifty metal is down nearly 6% today, was down 6% on Friday as well. What's the sense like? Is it a bit of an overreaction, or would you stay away at this point? How would you play metals?
So, metals and other commodities, everything is under pressure, and they are direct derivative of how you perceive global growth. And the way, the fear of recession in the largest economy in the world is going up, the probability of that, and also the impact of that, the impact of tariff on most of the economies in the world. Obviously, all the commodities will go through pain, and there is a fear that the demand for commodities can tank, and because of that, the prices can go down. And this sector is a huge capex sector where the operating leverages are very high. So obviously, there is a fear which is there, and that fear is playing on the mind of the people. I think uncertainty is not the time when people will buy metal, because metal type of sectors are being bought when there is a lot of certainty, when there is a risk on. Right now, no one is in a mood to have risk on. Everyone wants to take risky money off. So I think this will be preferred less. Probably right now, people will be more comfortable buying something like IT, pharma, or FMCG rather than buying metal.
Okay. Let's also talk a little bit about consumption, because some of those names in focus on the back of their numbers which came out, and trying to compare and contextualize this. A Godrej Consumer, for example, doing well in trade today, and how do they stack up in terms of their quarterly update numbers, Mahima, with that perspective?
Right. So I'll start with Godrej Consumer. Well, we've seen that it's completely weathered the storm that the markets have had today. And this is because the Q4 update overall in terms of revenue uptake was better than what was expected and what street analysts estimated. In terms of volume growth, they're expecting a mid-single digit volume growth and overall a high single digit revenue growth. Adani Wilmar is another company which has posted strong Q4 business update. They're expecting volume growth of around 7% and revenue growth has been around 36% YOY. Dabur, on the other hand, has posted a weak Q4 business update where they're expecting volume growths in low single digits and revenue growth will be flat as per the management commentary coming in. Lastly, Marico. Well, mid-single digits volume growth is something that is expected by Marico, and overall revenue growth will be in high double digits. Now, in terms of the retailers as well, revenue volume growth around 7% and revenue growth around 17%. Nykaa is expecting revenue growth to be around mid-20s, and Trent, we already saw that the revenue growth, standalone revenue growth stood at around 28%. But when Trent is being compared to retailers in the tier 2 and tier 3 cities, something like a V2 retail or bazaar style, V2 retail has seen a revenue growth of 69% this quarter YOY, and the same store sales growth stood at 24%. This is much better than, of course, V2 retail is very small as compared to Trent, but the growth that it has penciled in is much higher. Bazaar style saw a revenue growth of 55% and the same store sales growth stood at 20%. And lastly, V-Mart retail revenue growth stood at 17% and the same store sales growth stood at around 8%. So this is the overall roundup as to how Q4 updates and how Q4 has panned out in the consumption space, both for staples as well as retailers.
Okay, thank you so much, Mahima, for that. Sandeep, views with regard to specific stocks difficult to get, but what about your take with regard to some of the FMCG updates? What is your expectation now from the FMCG space?
So I think, FMCG will keep posting nominal numbers the way they have been growing. I don't see a big positive surprise in them because the tax benefits which have been announced, they will take some more time to percolate down. So the numbers will be broadly where they were earlier. But because, they are more defensive in nature and the certainty of them not getting impacted will be there. And that's the reason there will be more resilience in the FMCG index. So it is a good hiding place currently.
Okay, point taken. And Sandeep, your quick take with regard to IT as well. What are you expecting in terms of numbers this quarter?
So, I think, and this is what our view has been for last 7-8 months. We expected some correction because we believe that, the stocks were overhyped, the PEG ratios are very high. Now, I think there has been a good correction in last 2 weeks, and now the stocks are building in little bit of realistic growth. And I believe that, another few percentage of correction when the companies come and they update how they are seeing the demand environment, if that happens, then the FCF yields will start looking like more than 4% to 6, between 4 to 6% for all the large names. And that is the place where I have seen historically in last 20-25 years, most of the stocks make a bottom. So I think, the only thing which needs to be seen post that is that there is no increase in cost of doing business. The American administration should not come and, impose some restrictions which will increase the cost of doing business. If that doesn't happen, then I think with some percentage point correction from here, low growth will be built in and the multiples will be more reasonable.
Okay, Hemant, Sandeep, thank you so much for joining us this afternoon, giving us all of those.